Hi, good afternoon, everyone. Thank you for joining today's SGX Discovery series with Beansprout, where we will be discussing opportunities in European REITs. My name is Gerald, and I'll be your host for today. We are very pleased to have with us today Cromwell European REIT, Elite UK REIT, and IREIT Global. Representing Cromwell European REIT, we have Mr. Simon Gehring, who is CEO and Executive Director. Representing Elite UK REIT, we have Mr. Joshua Liu, who is CEO. And representing IREIT Global, we have got Mr. Peter Wiens, who is the CEO. We also have lined up an expert speaker from Cromwell Property Group, who will be sharing with us the outlook on the European real estate sector. So through today's sharing, we hope you'll be able to have a better understanding of latest developments in the European real estate sector and be able to get a better understanding of the European REITs. Without further ado, I will start by giving an update around recent developments on the European REIT sector before handing over to the different speakers, where we'll then be able to have an update from each of the different speakers on their latest views on the sector and how they see the developments going forward. We'll then end off with a Q&A session where you'll be able to ask questions to the management teams that we have with us today. So I'll start by giving a short introduction about some of the latest developments that we see in the European S-REIT sector. To the next slide. For those of you who have not heard of Beansprout, just to give you an introduction, we are a financial insights platform and we want to help you make better financial decisions. We would provide various research reports as well as insights on Singapore REITs, and you'll be able to find updates on the REIT sector, including research reports on the 3 REITs that we have today on our platform, growbeansprout.com. Next slide. For disclaimer purposes, today's sharing is for information purposes only and should not be taken to be financial advice. Next slide. Okay, so I think to lay the backdrop for today's discussion, I think what we are all very familiar with would be the cut in interest rates. What we have been tracking very closely is the cut in interest rates by the US Federal Reserve that started in September this year. So we saw a 50 basis point interest rate cut by the US Federal Reserve, and this was followed by another 25 basis points rate cut just this month. And I think that has actually driven quite a bit of movements within the Singapore REIT sector, as well as various asset classes. But what some of us may not be following as closely would be some of the action by the European central banks. So if I can go to the next slide, what we can see would be the interest rate cuts by some of the European central banks as well. What we may not be following as closely is that even before the Federal Reserve started cutting interest rates in September, we have also seen the ECB cutting interest rates in June. And so far, we have seen 3 rate cuts by the European Central Bank. And likewise, we've also seen the Bank of England starting to cut interest rates twice over the past few months. So it is not just in the US that we have seen interest rate cuts, but across Europe, we have seen such interest rate cuts coming through as well. Next slide. Okay, so you might be wondering what is driving this cut in interest rates by the European central banks. One of the key drivers for elevated interest rates previously was because we have seen inflation going up to fairly high levels, both within the Euro area as well as in the UK. But over the past 12 months, we have seen a significant moderation in inflation across Europe. If I were to look at the latest data that's come out in the Euro area, we have just seen the consumer price index rising by 2% year on year in October. So as you can see in the chart here, this is a significant decline compared to 2022, when at the peak, the inflation was actually at above 10% back then. If I were to look at the UK, we also see a similar trend where the latest data point that we have in September, the CPI rose by 1.7% compared to the previous year. And this is also a very significant decline compared to back in 2021, when inflation actually reached above 10% at one point in time. So the other key point to note from these two charts is that both the European Central Bank as well as the Bank of England have inflation targets to be at below 2%. And with the latest inflation numbers that have come out, what we do see is that inflation is actually close to or below their inflation target. So what does this actually mean for interest rates going forward? We can go to the next slide to look at what we can expect going ahead. So with inflation actually now below the European Central Bank's target, that actually leaves more room for interest rates to be cut even further from here. While we have seen actually inflation being fairly sticky in the US, we have seen actually the inflation numbers coming down in Europe. And what this means is that there is room for more interest rate cuts by the European Central Bank going forward and into 2025. So that is the overall macro backdrop that we see for the European REITs heading into 2025. The next slide. So what does this mean specifically for the real estate sector? We know that interest rates have an impact to the real estate sector, given that it would affect many different things, such as how these property assets are being valued, what is the borrowing cost that will actually affect both the buyers as well as sellers in the market. So I think what we can see from this chart is that with the hike in interest rates over the past 2 years, the prime yields for various property asset classes in Europe have actually gone up through 2022 and 2023. What we have seen in the first half of this year is that there has been a stabilization in the yields, and with the interest rates starting to come down, what we have seen is that in some selected sectors, the yields are also starting to decline. So what this actually means is that for the various asset values, we are starting to see some signs of stabilization, and in some cases, they have actually started to go up. On to the next slide. If I were to track some of the more recent activity, one of the key indicators that we can look at would be the level of investment volume within the real estate sector. So with the more elevated interest rates, the level of investment volume actually came down in 2023. But with the interest rates actually stabilizing and with the cuts that we have started to see coming through in the last few months, investment volume is starting to pick up once again. So to me, that is another sign that activity is coming back to the European real estate sector. And the forecast is that going to 2025, we'll see a further improvement in investment activity. Next slide. The other point I'd like to highlight is that while the fall in interest rates is generally positive for the European real estate sector, we have actually seen a divergence in terms of performance across various asset classes. So this is where we need to be doing the additional homework to understand what are some of the sectors, what are some of the markets that will do better compared to the rest. So using this chart, which shows the average European rental growth across different subsectors as an example, if you were to look at, say, office, then the expectation is that the growth for the next 5 years would actually be slower than the growth over the last 10 years. On the other hand, if I were to look at, say, the retail sector, then the expectation is that the growth over the next 5 years is expected to be stronger over the past 10 years. Okay, so just using this chart as an example, we can see that even within the European real estate sector, there is actually a divergence in terms of the performance across different asset classes. So if I were to look at each of these individual subsectors in more detail, if I can look at the next slide. Okay, I will look at three key sectors. I'll start with office, since this is probably one sector that some of us might be more familiar with. And what we see here is that in terms of the growth in the renter values, there is actually a very significant divergence between what is considered prime office space versus what is seen to be average office space. So using the UK as an example, you can see the very significant divergence in terms of the expectations on how much the prime office space value is expected to go up versus what is seen to be average office space. We have seen a similar trend in Singapore as well, where there is divergence between your grade A office, or what is seen to be prime office space, versus what is seen to be average office space. So then it is important to understand what is the asset class that different REITs actually hold and be able to find out which are the better quality assets. Next slide. Okay, so next I'll look at the logistics sector. This is one sector that's actually done very well over the past few years because of the growing demand from e-commerce, as well as some of the structural higher demand after the COVID-19 pandemic. So what we have seen here is that after the very strong growth in rents in 2021 and 2022, there is some signs of moderation in terms of the rental growth, even though it is still expected to be higher growth compared to what we have seen prior to the COVID-19 pandemic. Next, we'll look at the retail space. I mentioned earlier that that is one sector where the rental growth over the next 5 years is expected to be stronger than compared to the last 10 years. So what we see here is effectively something that is a rejuvenation in terms of the retail space demand as well as rents, where it is actually improving from a very low base, given that it has been on the decline even prior to the COVID-19 pandemic. So with inflation starting to come down, with an improvement in consumer sentiment, the expectation here is that the retail demand is expected to grow into 2025. Next slide. So having shared some of the key drivers, some of the risks that I'll be looking out for is that while the European economic growth is expected to recover further in 2025, it is a fairly delicate recovery, such that we are looking at 1.2% growth in 2025 compared to 0.8% growth in 2024. The other key risk to be looking out for is that as investors, for investors who have their dominant currency in Sing dollar, when we think about some of the REITs with overseas assets, then that can potentially present currency risk for those with their investment denominated in Singapore dollars. Next slide. Okay, so in terms of how does this affect us as investors of Singapore REITs, what many of us are familiar with would be the REITs with Singapore assets. But actually what is interesting to me is that there are a growing number of Singapore REITs with assets that are actually outside of Singapore. So if I were to look at the statistics of the 40 over REITs that are listed in Singapore, actually more than 90% of them actually hold overseas assets. Okay, so what we are going to dive deeper into today would be the REITs with European assets, and that is actually shown on the next slide, where we are able to see that they have got fairly diversified exposure. Next slide. Okay, so why look at European REITs? If I were to look at the dividend yields offered by different REIT subsectors, some of the REITs that we are familiar with in the Singapore office, retail, or industrial space now offer a dividend yield of above 5%. This is higher than the Singapore 10-year government bond yield, But if I were to look at some of the other subsectors, such as European REITs, they currently offer an average dividend yield of 9%. Okay, so this might be one of the reasons why an investor might want to be looking at the European REIT sector. Next slide. Okay, so if I were to just give a very quick introduction about the three REITs that we have with us today, they have got diversified exposure. Cromwell European REIT with a portfolio valuation of 2.25 billion euros as of September 2024, and being involved in the industrial logistics as well as office space within Europe. If I were to look at some of the other REITs that we have with us today, we have got IREIT Global with 53 office and retail properties in Europe, and Elite UK REIT with 149 office assets just solely exposed to the UK. Next slide. Okay, so in terms of what I'll be looking out for in terms of selecting a REIT, there are three things that we have as a framework within Beansprout, and we'll always be looking at things like the fundamental strength, which will be things like the quality of the sponsor, as well as the occupancy rate of the property. We'll be looking at the financial strength, which is really around the debt levels, as well as the debt expiry profile of the REIT. And last but not least, the valuation, which is around the dividend yield that we'll be able to receive, as well as the price to book valuation of the REIT. So those are some of the things that we can pay attention to as the different REIT managers present to us today. And if I were to just do a very quick comparison across some of these key factors, on to the next slide. Okay, what we do see for all three European S-REITs is that they have an occupancy rate of close to 90% and above as of September 2024. Okay, so next slide, in terms of the leverage ratios. So in terms of the leverage ratios, what we do see is that for the European S-REITs, leverage ratio of between 37% to 44%. And next slide, to the dividend yield. I mentioned earlier that they have got an average dividend yield of 9% and above, and that would actually range from above 8% to those that offer above 10% dividend yield. So with this metric in mind, I think what we can look out for would be really around how each of the different REITs intend to be able to improve the occupancy of the properties, how they intend to manage their capital structure against the changing interest rate environment, and how they intend to be able to sustain the dividend payout. Next slide. So in summary, what we have seen is that European central banks have started cutting interest rates with easing inflation. We have seen the real estate valuation stabilizing as the yields have peaked. And why we are looking at European REITs today is because they offer exposure to the improving sector outlook, and in terms of the dividend yields, offering on average 9% and above. So on to the next slide. If you want more research on some of these REITs that we have talked about, the sector outlook that I've discussed, do feel free to visit our website, and I'll be happy to be taking some of your questions today as well. So with that, I'll hand over to our next speaker, where we'll be able to get a more detailed outlook on the European economic growth as well as the real estate sector. Over to you, Tom.
Thank you, Gerald, and good afternoon, everyone. My name is Tom Duncan. I'm Head of Research, Strategy and Product at Cromwell Property Group. And over the next 15 minutes or so, I'll give you our take on current European real estate and economic conditions. I'll also highlight where we see the performance opportunities going forward. Gerald has helpfully teed up some of the points I'll cover today, but I will go into a bit more detail than we've just heard. So as you can see here, my slides today are split into 4 different sections. To start with, we consider economic conditions in Europe, and I'll highlight how we see a modest resumption of growth and more stable market conditions. I'll move on to consider real estate investment, where, as we've heard, pricing has stabilized and where there's much more activity likely next year and beyond. I'll move on to consider occupiers and outline in a bit more detail the rising polarization trend, which we've heard about and which I think is critical in understanding the European real estate landscape. And to conclude, I'll consider how you can capture the performance potential for certain types of real estate that we think exist in current conditions. To start with then, let's turn to macroeconomics. The European economy has now returned to a slow and steady growth trajectory, albeit one that's modest compared to other global regions. In Q3, Eurozone GDP growth was 0.4%. That was double forecaster expectations. We've seen slightly lower GDP growth in the UK at 0.1% in Q3 and 0.3% in the wider European area. PMI was neutral in October, but it has been volatile, and I think this does point to some structural weakness in certain parts of the European economy, like manufacturing and construction. I think it also points to some weakness in certain key countries, depending on their economic structure. So we see that countries with a greater exposure to services, like the UK, like Denmark, and Spain and CEE, have stronger leading indicators than other countries with a higher exposure to more industrial processes. I think that's a key factor, the differentiation across Europe to consider when looking at real estate investments. On the next slide, you can see, or here, yes, you can see a real strength of the European economy, which has been unemployment. And this continues to be near record lows in most countries. Whilst this can create some short-term issues around labour availability and shortages in certain industries, and also wage price inflation, overall, unemployment contributes to rising GDP by aiding consumer confidence and spending. You can see from the chart on the right here that consumer spending over the next 5 years will be far stronger than what we've seen over the previous 5 years. And this will be a key factor powering the continued recovery in the European economic landscape going forward. I would say, though, in addition to what Gerald highlighted previously, the labour market is a potential risk for the European economy if it does soften. And there are some leading indicators that in some select industries that might be occurring. So that is an issue to watch, I think. So turning to rates and inflation. As we heard from Gerald, it does seem now that European inflation has been vanquished. Inflation fell rapidly in 2023 and 2024, driven largely by lower energy prices and weaker consumer goods price rises. Oxford Economics, similar to Gerald, predicts that inflation will soon settle around the 2% target. And low inflation, coupled with the modest economic growth backdrop, make further rate cuts likely. As we heard, we saw consecutive rate cuts from the ECB in September and October, and the long rates have continued to fall. Oxford Economics predicts that there'll be further cuts from the ECB in December, or so next month, and also at every subsequent meeting to mid-2025. The Bank of England is likely to be more cautious. They recently stated in cutting the interest rates, they noted to that monetary policy will need to remain restrictive until the risks of inflation returning substantially to below the 2% target for a number of consecutive periods has dissipated further. And so as a small open economy, the pace of cutting in the UK is more likely to be aligned to the pace of the Fed rather than the ECB. But certainly the outlook is for downward interest rates in the UK, much like Europe as well. Falling interest rates have already improved consumer demand and by extension European growth expectations, as we saw previously, and this will continue. Overall then, in terms of the European economy, a stabler, more certain economic outlook with modest growth, tamed inflation, a resilient labour market, rising consumer spending, and falling base rates bodes well for investor and occupier demand in European real estate. And I'll consider both of these in the next two sections. To begin with, real estate investment. The table here adds a bit of colour to what Gerald was saying in terms of the stabilised pricing that we see across Europe. and the fact that in some countries that are more advanced in their repricing cycle, like the UK, we've seen yields hardening already. Survey data from the likes of Preqin indicates that most European real estate investors believe that their portfolios are now fairly or undervalued. Given the outlook for interest rates and prime yields, it seems that real estate is well placed to be at the peak of the yield cycle, with widespread hardening likely as the interest rate environment improves for investors. Turning to investment volumes, as we saw, repricing has yet to stimulate a meaningful rise in market activity, although we do expect that to change in the near future. In Q3, European real estate transaction volumes were flat on the year and down slightly on Q1 and Q2. There was no significant geographical variation, with deal volumes in countries like the UK, the Nordics, and Poland higher year on year and quarter on quarter. But in other countries like Germany and in France, investment volumes were down. Deal volumes are, of course, a lagging indicator of improving sentiment, and there is other data which supports a positive shift in the investor conditions. For example, the number of big deals, which has been climbing, and a small increase in the number of deals in contract. So we do think that real estate volumes will improve towards the end of this year, and that momentum will carry into 2025 and beyond. In terms of sectors, the established hierarchy of investor demand has held throughout the first 9 months of 2024, with transaction volumes for sheds and beds being up year on year, whereas we've seen transaction volumes for retail and offices fall. In retail and in office, in particular, it's notable that so far this year, we've seen no large transactions of 400 million euros or above, and that's quite unusual. Looking ahead, we think that investors should see much greater activity in 2025, and we'll see more investor activity across the risk spectrum. That said, we do expect demand to be focused on assets, depending on their quality, and also certain sectors like logistics. And I'll talk a little bit about why we think that more in the next section. So this section, let's consider the occupational market, and where the main message is polarization. You can see here data from CBRE, which looks at take-up over the last few years, as well as vacancy rates. And you can see that for both sectors, take-up so far this year has been relatively low, and vacancy has risen. Now, CBRE don't produce similar data for retail, but from my conversations with agents, I can see that it is a similar story in that sector. I think weaker take-up and higher vacancy really reflects the fact that we have had a weaker economic outlook over the last year or two, and uncertainty, which has prevented occupiers from making leasing decisions. And there's been a high rate of development completions of developments which got started before the repricing cycle, and those completions are nearly at an end. So going forward, with a stabler economic outlook and more certainty, and a falling development pipeline and supply, we think that these metrics will look a lot better next year. Now, turning to rental growth, a key feature of the landscape has been a focus really on specification and location, with high demand being highly concentrated on assets which deliver on specific characteristics. This has led to quite strong rental growth for prime assets in office and in logistics over the last few years. Going forward, we see more consistent, more measured rates of rental growth, which, as we heard at the start, will be a bit lower than what we've seen over the previous few years, given the interest rate environment and inflation. But in every case here, it will be above inflation level rental growth. The key fact to note here, though, or our key view, is that rental growth will disproportionately accrue to the better quality assets, which align to more demanding requirements from occupiers around location and specification, which will lead to widening polarization in the market. Here is our take on the drivers of occupier demand selectivity in terms of stock. These, of course, vary by sector, but I think the main takeaway you should be left after this slide is that occupiers are being more demanding. They expect more from their assets, and they are prepared to pay to get it, even if and the reason really is because demand exceeds supply for these types of good quality assets in Europe. To give you an example, you can see here that despite office vacancy rates of 4 to 12% in the largest European markets next year, prime rental growth in all of these markets will be robust and above inflation over the next 5 years, according to CBRE's forecasts. We see significant performance potential as a result for investors who own or can create the minority of stock sought by modern occupiers in all three main sectors. So tying all this together in the last section of my presentation, we think that European real estate looks well placed to deliver strong performance in the medium term. On this slide, you can see total return forecasts for offices, logistics, and high street retail over the next 5 years. And you can see that there will be a broad-based recovery with compressing yields and rental growth over the medium term for every sector. The latest performance forecasts that you can see here from CBRE are the strongest in over a decade, with predicted annual returns for offices of 10.6%, for logistics of 10.1%, and of 7.8% for high street retail. So I think investors look really favorably positioned to benefit as this plays out over the next few years. Key feature, though, as we've heard you've heard a number of times already from me and Gerald, is about polarization and a widening difference between prime and secondary stock. I think it really is a tale of two markets, with the minority of stock that is aligned to occupier demand, capturing an outsized share of capital growth and rental growth as well. And stock which isn't aligned to modern occupier demand being subject to diminishing returns, uncertain income, high capex, and potential outwards yield shift unless it is repositioned. Hence, we believe in making investment decisions is key to focus on local market dynamics and to being highly attuned to occupier need. And if you do that well, the prospects of rental growth and positive yield shift by fulfilling the supply gap for really good quality stock where it's needed, we think are compelling. Here is a high-level summary on this chart, on the previous chart, really, of just the characteristics that we want to be seeing in offices, in logistics, and in retail assets that we think will perform the best in the future. So in summary then, that concludes my presentation, but to recap the key messages, the European economy has returned to modest growth and falling rates is likely to be the key message going forward. We think real estate pricing has stabilized and higher activity looms. And we think that performance will be really determined by the flight to quality by occupiers and investors. And if you can position yourself on the winning side of that equation, you really do look well placed for sustained performance going forward. Ultimately, better quality assets lead to better quality tenants as well. And so that really will manifest in terms of demand and hopefully rental growth as well. That concludes my bit today. So now I'll pass you back to Gerald to introduce the next speaker.
Thank you, Tom, for the very detailed sharing. Next up, we have got IREIT Global. Very pleased to have with us today Peter, who's the CEO of IREIT Global, who will be able to share how he intends to tap the opportunities that Tom just shared with us earlier. Over to you, Peter.
Hi, everybody. Thank you for the invitation. I will so present you a few figures about IREIT Global. I will then give you the main points of attention of our coming month and a few prospects for the, I would say, the longer future for IREIT Global. So let's jump into the presentation. Next slide. So first, a quite overview of our portfolio, which is 76% invested in office assets in Germany and Spain, and 24% invested in retail in France. We have two sponsors. IREIT Global has two sponsors who are Tikeo Capital, who is a French headquartered asset manager with over 45 billion euro of AUM, and we have City Development Limited, who you may know, who is a Singaporean headquartered developer. Next slide, please. Okay, on these slides, we have a few more information. What we can say is that our strategy targets assets in the strongest European economies, mainly the Western Europe ones, and we aim at having a diversified portfolio across office, retail, and hospitality asset classes. We adopt an active asset management approach on it, and our portfolio comprises today 53 properties and presents a slightly below 90% occupancy rate. We can go now to the next slide. So we have on this slide our main KPIs, which remain quite strong in 2024, with on top of our occupancy rate we mentioned just before, nearly 5 years of weighted average lease expiry on the whole portfolio. We have an aggregate leverage ratio of 37.7%, which is quite lower than the average, I would say, of the market. And we have quite low weighted average interest rate at 1.9%, which is the consequence of a systematic hedging of our loans in the past. So today we benefit from this relatively low cost of financing. On the next slide, we have a quick focus on the asset management side. So what we can say, and this is quite consistent with what was said before, unlike 2023 and before, we generally speaking see better traction on the letting side, with in the case of IREIT Global, numerous new lease contracts signed in the preceding months, and a rather well-filled pipeline today. This is, as an example, particularly true for our office building in Darmstadt, which was fully vacated end of 2022. So nearly at the worst period, I would say, to have an office building vacating, and which is being backfilled and will hopefully present a 66% occupancy ratio in the beginning of next year, with quite long lease agreements, which provides good visibility on the rental income for the coming years. We see the same good trends on the letting side on our Spanish portfolio as well, which is likely to see its occupancy rate bounce from 70% to 77% in the coming month. And of course, our objective is to grow these two occupancy ratios to a higher level, and our team is working hard on this side. In terms of asset management, we can also add that the indexation is well past in the rents, as they grew from 5.8% like-for-like this year compared to the same period last year. So this is quite interesting, because it shows that our assets are able, yes, to cap inflation in the rent, which is normally one of the benefit of real estate, being a kind of protection against inflation. Last, we have our Berlin project, which consists in repositioning, full repositioning of a single-let, single-use office asset to a multi-let mixed-use asset comprising hotels, office, and retail area. So this is a major asset management project, and this is clearly our, I would say, a differentiating factor compared to our peers, as S-REITs generally do not steer big repositioning projects on their own. But as far as we're concerned, we consider that we have the capabilities and experience to handle it, especially with the support of our sponsors who are used to handling this kind of project. We have their full support, by the way, and we want actually IREITs unit holders to benefit from this project's strong value creation, because we think it's a pity that our unit holders do not take advantage of the potential, the big potential upside of this repositioning project. So doing it on our own allows us to bring value in our I would say understanding to our unit holders. For sure, this will create a drop in rental income for next year, and maybe the year after. But this is the intention of the manager to do its best effort to limit the DPU impact. Let's go to next slide, please. So now it's rather looking ahead, yes, in the future. In our analysis, from a real estate point of view, the worst is behind us, as it has been said before several times, from a macro point of view, we are now in a new cycle of the interest rates, which are decreasing and will now, I would say, in a permanent way, decrease in the coming months and years. The pace of this decrease is not, of course, known precisely, but we know the direction, which will be a decrease. And of course, the decrease in interest rates will support the real estate values to increase again. We also see the beginning, as I mentioned before, of the recovery of real estate letting and investment in Europe. Besides, I think it was not clearly mentioned before, but on the office real estate market, we clearly see a kind of rebalancing with regard to work from home habits, which have been quite strong, coming fast, and with a strong effect in the last 2 to 3 years. But we see today more and more companies requiring their employees to come back to office. Of course, it will never be 100% office time in the future, but I think that at the end the balance will be something like I would say in average 1 to 1.5 days per week maximum of home office, and that means that we need office buildings, and we will need office buildings in the future. This market is not dead, as some may have thought when we were in the middle of the crisis. And I want just to remember that on the retail asset classes 10 years ago, it was kind of the same crisis. I mean, with the advent of the online shopping with Amazon, AliExpress, etc., many people, many analysts were saying that the retail market was dead. Today, and we have invested in the retail market in the last few years in IREIT Global, we can see that this market has made this transition, and now there are retail asset classes that are working well, such as retail parks. Proximity retail parks are very well working in several countries. So I think that it will be the same for office building market. If we look behind a few years, in a few years, we will yes think about this period and confirm that the market has recovered. To conclude, I would say that our main objectives for next year and the following are: first, for next year, 2025, to steer properly our Berlin project, work on increasing the portfolio occupancy rate of our other buildings, of course, and then start thinking about IREIT's next IREIT Global next chapter by building scale. Keep diversifying the portfolio, because real estate is cyclical, and so in our opinion, being exposed to several asset classes and geographies help to mitigate the effects of these cycles, because in a cycle you are sometimes at the top and sometimes at the bottom, and as such we may consider opening new geographies such as UK in the coming months. That's all for myself.
Thank you, Peter. Okay, we'll have time for questions for the different REITs that are with us today. I already see some of the questions that come in through the chat, but before we go into the Q&A session, we still have got presentations by IREIT UK REIT as well as Cromwell European REIT. Next up, we have got a presentation by IREIT UK REIT. Mr. Joshua Liao, who is the CEO of IREIT UK REIT. I think the last time I met you, you were still IREIT Commercial REIT. So maybe you can share with us some of the recent developments and how you are positioning for some of the drivers that have been shared earlier. Josh, over to you.
Thanks, Gerald. Hi, good evening, everyone. My name is Josh. I'm the CEO of IREIT UK REIT. Very happy to be here, and thanks for taking the time to join us this evening at this webinar. So if I could move on to the next slide. I think for the benefit of those who have not followed our story, we're actually UK REIT listed in Singapore. I think by that we really mean it in the sense that we actually benefit from UK REIT structure. We are taxed no more than the REITs that's listed on the LSE. As it goes to show, I think many of the REITs that we have in Singapore, as Gerald has elaborated, it's a bit of a REIT hub that we have become, and we are the only REIT that is listed on the SGX that has assets in our entire portfolio in the UK. But that's not the only thing that's unique about us. Our asset base is also almost entirely leased to the UK government, and the leases that we have as well, these are signed at the very highest level, at the Secretary of State level, not with the local councils. So pretty much, very much as sovereign credit as you could get. 100% of our assets are freehold and on long leases, and these are also leased to the UK government on the triple net basis, and these assets are dotted all around the UK. So I think maybe I should quickly explain what these assets are being used by the UK government for. So in the UK, there is the system of social welfare, and that's been around for more than 100 years. It was actually a system that was incepted by the Labour Party more than a century ago. And I think one of the key policy that the UK government has with regards to the job centres is that they need to be within 20 minutes of bus and train travel. As such, these centres or these properties that we have are very well located within city and town centres all around the UK. So what's a job centre? We don't have something that's similar in Singapore and Asia. But I think the closest you could think of them is that they are actually government facilities like community centres. So in the UK, if you have unfortunately lost your job, you could actually walk into a job centre that's 20 minutes away. no more than 20 minutes away, and get some financial assistance to tide you over during the short term whilst you look for a new job. And they will also help the claimants to actually find the new employment based on their requirements. So that's really how we're set up. Before I move on to the next slide, very quickly to talk about our sponsors. Sunway, I think, might be a bit more familiar to some of our investors in this part of the world. Sunway is a large real estate developer that's listed in Malaysia, but I think they also have a little bit of involvement with us since 2018. The other one that we have is Holy Group and IREIT. IREIT is substantially funded by Holy. The Holy is one of the homegrown construction and developers in Singapore. Not listed, so probably not quite prominently on the radar, but also a very strong financial sponsor that we have. Moving on to the next slide. I think just to compare with where we stand in terms of yield. Because our tenants are the UK government, we do not only benefit from having that credit stability and income certainty. Our rents are also collected 3 months in advance from the UK government. Our current REIT yield is about 10-11%, depending on the share price of the day. And this compares favorably, I think, with the rest of the Singapore REITs average yield, as well as 10-year UK gilt bonds, which is your UK government sovereign credit as well. Moving on to the next slide. I think we recently announced our third quarter highlights. So quite a few interesting and good news to share with the market. Number one, I think we've announced in the market that our DPU has finally increased by close to 4%. Year on year, and this for the 9 months compared to the 9 months last year. And this is really from higher distributable income as well as tax savings. We also very recently locked away our refinancing that has been extended out for another 3 years. We have also achieved and locked in an interest rate of 5% by hedging at a very good rate, and reduced our borrowing cost by 20 basis points. At the start of the year, I think many people thought that our interest rates would actually increase once we refinance, and that's actually not the case. So that's something we're quite proud of. We've also divested one of our assets at 42% above valuation. And I think in this year, we have collected about 1.4 million of dilapidation settlements. We have also announced a very small rent reversion of 5.3% for one of our properties. So this quarter was quite a good one for us. Last but not least, our portfolio occupancy rate has also increased. As of 30th June, it has moved up to 93.9%. Moving on to the next slide, I think this is quite a good slide for us to express what's our strategy. We've entitled this page or this slide Right Place and Time. I think around April this year, we've announced in the market that we would like to have a bit of flexibility in managing our investment strategy. So whilst I think we're quite core in wanting to continue to invest in social infrastructure, and that is the job centers as well as government workspaces. Over time, with some of these vacant assets, it might make sense for us to reposition them as student accommodation or build to rent residential. Now, there are a number of factors why this makes more sense. One, I think because of the assets, they need to be well positioned. Because of the requirement for them to be within 20 minutes of train and travel. They tend to be very well located within city and town centers, usually on the main street or the street behind the main street. So very well placed. And in the sort of case where these towns or cities are student or university towns, it makes a lot of commercial sense for us to actually reposition some of these as student accommodation. Of course, not every asset will be suitable. We do have a filter. So some, other than market viability, it's also the scale of the opportunity as well as the risk as well as the returns of the undertaking. So some of these assets, if they might be too small and not of scale, I think will be very we're very open to monetize them and take that capital to reduce gearing or to return it back to our unit holders. Moving on to the next slide. Next slide, please. So this is a colorful slide, a bit busy. I think I just wanted to quickly summarize in one slide what our key priorities are between this year, or the remaining months of this year and the next year, and where my management team as well as my focus will be. One is on proactive asset management. We do have some leases coming up in 2028, which I think we're very minded to extend that lease profile out into various maturities, but also to move them into a much longer WALE. That's, I think, number one. Number two, with regards to asset management, it's also trying to find if any of our assets could actually be getting better valuations through highest and best alternative use. Second, I think capital management. When we spoke to many of our investors, many of them expressed the view that they would like to see sub 40% long-term gearing. So that's something that we're working through. We have, I think, in the past year or so, generated about 4.6 million of 4.6 million of divestments, and this was done at about 19% premium to valuation. We have also collected dilapidation settlements, and we've used these amounts to reduce our borrowings and to bring our gearing to its current level. Now going forward, with some of these renewals that we are planning, with the asset enhancement as well as the repositioning that we're planning, we expect that the valuation would also eventually increase once we've done that. And that should also bring our gearing down. So it's quite, I think, in line with our strategy to bring our capital structure to a much lower level. Last but not least is to improve liquidity. So on this, there are a few fronts. One, I think we appreciate platforms like this event, and it gives us quite a fair bit of opportunity to tell our story, so that there is a way for us to communicate our strategies as well as what we plan to do, and that hopefully will help translate into improved liquidity. Over the past year, we have also gotten more brokerage and banks to cover us from equity perspective. One of the big supporters we have is, of course, Beansprouts. I think that has also helped to enhance our visibility and investors' awareness of ELITE UK REIT. I think that's the 5 slides I've got. Maybe I'll hand it back to Gerald.
Thank you, Josh. Okay, next up we have got Cromwell European REIT. Pleased to have Mr. Simon Gehring, who is Executive Director and CEO of Cromwell European REIT. Simon, over to you.
Thanks, Gerald, and thank you to your company and to SGX, and obviously thank you to everyone participating on the webinar tonight. And I realise that I'm standing between you and dinner, so I'll move pretty quickly, as many of you will be familiar with the Cromwell European REIT. But if we can turn to the next slide, please, next one. Yep. So just to recap, this is a very large portfolio. This is almost 3.5 billion Singapore dollars. It's over 100 assets. It's almost 2 million square meters, 20 million square feet. It's more than 2/3 the size of the Singapore CBD in total area. 1,000 leases, majority weighting to logistics, but it's very much a barbell approach to portfolio construction. We're across 10 countries. We want to make sure that resilience comes through in both the income side and the returns to investors with the way we've set this portfolio up. We have very much core assets with very long-term leases, 10, 15-year leases. We've got core plus type assets within the portfolio where there may be a little bit of vacancy, that with the 200 staff, the 200 Cromwell staff that we have on the ground through the 14 offices, the 10 countries that we invest in, they're able to add value to those particular assets that may have a little bit of vacancy And then we've got a significant portion of assets that lend themselves to some material upgrades, both from a logistics perspective as well as from an office, prime located office assets. So with that total spectrum of assets across so many countries, that we're trying to really reduce the risk of any individual action from a tenant or any individual action from a particular participant. And so that provides, for example, when the economy is soft, as it has been, we're still able to deliver earnings growth, income growth. Even the example of COVID back in 2020, we only lost 500,000 euros of rent out of a 200 million euro rental portfolio. Europeans believe in contract law. The leases have annual inflation. And so we're able to enforce our position as the property owner to deliver the income that ultimately delivers the dividend to you as the investor. So when we think about this portfolio and more generally with REITs, you're able to invest in many REITs. The three REITs presenting to you tonight are the European experts. And so while other REITs are moving into Europe or into China or into the US, they're doing so from Singapore. Whereas from here, we have the boots on the ground. We have people like Tom that's been on the call earlier tonight to be able to guide the investment decisions, to be able to talk Finnish in Helsinki or Polish in Warsaw or German in Munich, to be able to deliver those better returns. The strategy of the REIT is to not just drive the current rental income through our inflation indexation clauses, but also to lease up some vacancy that can drive more earnings growth. We're roughly 7% under rented. So as those leases expire, as we renew the leases, we're able to release them at higher rates. And you'll also see in this presentation, again, re-emphasizing Tom's earlier message, that many of the prime parts of office within Europe have very low vacancy. So this is very different to the US. And I think that's an important distinction for this session tonight, is really to show why Europe is very different to the US and very different to China. And I'll show you how we'll take advantage of some of those opportunities. But our strategy is ostensibly changed 3 years ago to move the portfolio to a majority of logistics. We could see before COVID the increase in e-commerce, that where Europe had been behind that of here, say in Singapore or in the US. We could see that transition to a more logistics-minded, more e-commerce-minded retail. The second aspect that has driven us to that move to majority weighted to logistics and light industrial is the onshoring, the movement of the supply chain, which has previously been very global. Now we can see with the geopolitics situation, we're just trying to stay ahead of that trend of more manufacturing supply chains being brought back into Europe or back into their other locations. And so that very much drives the demand for space. So if you imagine, for example, semiconductors, ASML is one of our tenants. They're obviously top three sized European companies. They make the fabs that make the factories for people like TSMC. Europe itself wants to be much bigger in semiconductors. And so as they move up to a supplier of more chips, for example, they require more warehouse space. As they look to build more parts for EV cars, again, that will build more space. As they move for more solar panels, again, that will demand for more logistics space. So there's lots of tailwinds as to why we're moving to logistics. From a share price perspective, because ultimately you're investing in a REIT, you're investing effectively through the stock market, and so you want to see our share price improve, as well as receiving the dividend, so that you can get the dividend and you can get an improvement in your capital value of your dollar, hard-earned dollar that you invest into the REIT. So we can show around the world, and even here in Singapore, that logistic and industrial REITs tend to trade at or above their NAV, whereas the office weighted REITs tend to trade at substantial discounts. This is not just about the sentiment of working from home. And as Peter described, that trend is reversing and we're seeing more people come back into office. It's just that there's less capital required to keep a warehouse running over a 10 to 20 year than an office building, where there's a lot more capex is required in that office building. So we know that the more we move to logistics, the higher the share price, the closer to NAV that we trade at. And this is demonstrated on the next page, if we can turn to the next slide. Next slide. Yep. So this is the performance of the Cromwell European REIT relative to the SGX, and this is really driven by two things. Our outperformance recently has been driven by, first and foremost, the reduction in interest rates. The environment in Europe is being boosted by the reduction in interest rates. Just like the brakes were put on in 2002, now the foot is being put on the accelerator, which will manifest itself into higher asset values, as well as stimulating economic growth, which ultimately leads to higher income growth. So certainly the European REITs, which again is why we're here tonight, benefiting from the more aggressive ECB rates and driving that improved sentiment towards European real estate. The second aspect that's driving this unit price outperformance is again this transition to the high growth and less capex required logistics and light industrial. And so that's also supporting the growth in the share price. If we can turn to the next page. It wouldn't be a European REIT presentation without a discussion on sustainability. This is important for a number of reasons, not just you as the unit holder looking to make sure that the money that you invest with a company or a management team are incentivized to look after that capital from a governance perspective and a sustainability perspective, but it's also about driving returns. How do I mean? Firstly, European tenants in particular, European companies in particular, have their own GHG, greenhouse gas emission, carbon dioxide emissions targets. So if you as the property owner can deliver a more energy efficient building, then you're going to attract more tenants and they will pay a higher rent. We know of the energy crisis of 2022. And so if we can make our buildings more energy efficient, that also makes it cheaper for the tenant to operate in those buildings because their energy bill ultimately is lower and they get access to more sustainable power. So roughly 40% of our power now is from green sources throughout the portfolio, again going to trying to manage both the corporate aspirations of tenants as well as the practical returns driving decision making for those tenants. And then from an endorsement factor perspective, many of you have heard of MSCI, very large global rating, an index company. They run an ESG rating guide, and we are AA rated. There's only 2 other REITs in Singapore that have that AA rating. So that's on the environment, that's on the sustainability, and that's really on the governance. And that's something that we take, again, very seriously here at Cromwell European REIT. Onto the next page. That's manifested itself out into some reasonable results. We just announced our September results. We're still able to deliver 4% distribution growth over the quarter on the prior quarter. Again, the benefits of that 7% NPI growth coming through, that net property income growth. And that's really, coming from both the indexation effect, the rent reversion on new leases, but also on AEI. And I'll touch on AEI in a minute. On the balance sheet side, we're just 40% net geared. We're BBB- investment grade rating, with Fitch recently putting us onto a positive outlook. And we've recently, in the last 2 weeks, refinanced 470 million euros of debt. So again, the next couple of years from that balance sheet perspective, very strong. If we can turn over to the next page. Just wanted to highlight here a couple of statistics from both our office portfolio, our logistics portfolio, and the overall portfolio, which we've crammed into this one page. But I guess what we're trying to show here is a couple of things. The columns on the chart reflect the rent reversion. So this is the higher rents in a new lease relative to the rent in the prior lease. Also wanted to show on the right-hand side that office actually is going up in occupancy in the last 12 months. And in part, that's a reflection of some of the upgrades that we've done to our assets. And then on the logistics side, we're running at pretty much full house, 95 to 96% on such a large portfolio, based on the amount of activity, with leases expiring and new leases starting. That's pretty close to full house. On to the next page. So how do we drive our dividend? How do we drive such a high yield, currently trading at around a 9% dividend yield? Well, it's really coming out of the yield of the assets. So our current yield is 6.3%. That compares slightly higher than the average yield currently in the market, as you can see with these three yield charts. But the other aspect here is that, as Tom mentioned, and as Peter has also put forward his proposition, that we are now in a stabilization. The last 2 years, the brakes have been on, valuations have fallen, yields have increased. Now with this recent rally in interest rates, we're starting to see that buffer between property yield and financing yield start to widen again to its more normal 3%, 2.5%, 3% buffer, which means if I buy a property on a 6% yield and I can borrow all in at 4%, I can make a higher return on the dollar of capital that I'm investing. And this is why investors are getting more interested in Europe, because this yield spread is now coming back in. Even for prime assets in the Netherlands or in Germany, starting to see those green shoots of more investors coming into Europe to take advantage now of this spread. If we can turn over to the next page, Peter mentioned that they're looking at AEIs. We've delivered our first major project. So we're very proud to announce that we now have the second most energy efficient office building in all of Italy. We took a very old office building. We invested 33 million euros in upgrading it. We have attracted headquarters for such eminent companies like Universal Music Group. So many of you will know Taylor Swift. She likes the gold tower that we've built, and she likes the energy efficiency of this building. So it's fully leased on completion at rents 40% higher than when we started the construction. So it's just not fair to say in the European context, its office rents are falling. That's not true. When you convert a B-grade office building into a prime building in that well-located part of, say, Milan or of Amsterdam, you're able to get the good rent increases. You're able to attract tenants into your building because they themselves want better quality building. As Tom mentioned before, only 20% of the total European office stock has this BREEAM certification of excellence or very good. This is what tenants are looking for, but there's just not enough stock. So if you can deliver this type of quality of energy efficient, nice amenity, bike changing sheds, etc., coffee shops, that will attract tenants at the expense of business parks or older buildings that don't have air conditioning systems or rely on gas heating, that type of older type of building. That's where the difficulty, that's where the bifurcation is happening. So the C-REIT office portfolio, while it's a smaller part of our strategy, it's an important part of the strategy of trying to deliver higher returns. And if we can go to the next page. Yeah, here's 4 other examples of major projects that we're in various stages of planning. It does take longer in Europe to work through the planning process. It's not as efficient as here in Singapore, where we've got more forward-thinking town planners here. It does take longer in Europe. Having said that, that also supports those with the expertise, because it is harder to get plans approved. And therefore, if you've got the local expertise, the local connectivity, then you will ultimately get these projects approved. So the first 3 buildings here on the left-hand side are office projects, roughly 60 to 100 million euros each, so quite substantial. taking them from B-grade assets that are in great locations to actually delivering what tenants want. And so that building in Amsterdam, for those that have been there, it's right next to the Grand Central Station on the Grand Canal. This will be one of the best buildings in Amsterdam. By that, I mean the most high rents that we'll be able to achieve, possibly even doubling the rents that we currently have here in this older building. On the left-hand side, for those that are familiar with The Hague, this is the largest commercial office building in The Hague, which has Goldman Sachs European headquarters in there for their asset management business. It's got Aramco's major oil business. It's got National-Nederlanden, which is one of Europe's largest insurance companies in there as their headquarters. Again, we're getting 40 to 50% rent increases by improving the energy efficiency and carbon emission of these assets. And then the jewel in the crown on the right-hand side is Parc de Dock. Many of you have heard me talk about this asset for some time now. This is 10 hectares right in the inside of the periphery of Paris, right where the Olympic Village was recently used. Obviously, stadiums in this location, new infrastructure, new metro stations, line 14, for example, a brand new North Paris hospital, which would be the largest hospital currently being built in Europe. All of this is happening on our doorstep. So we're working through a very detailed town planning master plan at the moment. Watch this space. This could be a 500, 600 million euro 10-year project. This is 10 hectares of space. Now, at the moment, we're in no rush. When we bought this asset 6 years ago, the rents were 90 euros a square metre. Today, the rents are 170 euros a square metre, so almost doubled. So when you think about Paris, maybe you're thinking, it's low growth. How can you possibly get rental growth in Paris? But again, this is very important to get the point across that there is just less and less last mile logistics as more of these older properties are converted into housing or public infrastructure, and thereby reducing the amount of warehouse space within a 3-kilometre radius of downtown Paris. So we're really benefiting in this property at the moment from very high rent growth. So we've almost doubled the value of this asset, not by spending money on it, but just by the fact that it's a very rare commodity asset within Paris. So we're looking very carefully what we can do with it. But in the meantime, it's delivering a very high amount of cash flow. On to the next page. So in summary, it's a very resilient portfolio. We're seeing that with both our occupancy level, with the rent reversions, with our AEI opportunities to take advantage of our well-located assets. They're predominantly freehold. I know Josh mentioned that in the presentation. I know Singapore investors are very canny. They understand that if you have freehold and you want to add value to the building, then you get to keep that. You don't have to share that with the owner of the ground lease. So that's a very important part of our portfolio activities. And then we look after the balance sheet, BBB-, investment grade rated, positive outlook, just refinanced 470 million euros of debt. So good availability of credit. We are going to change names shortly from Cromwell to Stoneweg. That's our new investor. We're excited about this. They're based in Geneva. They are European. They are complementary to what we already do. They've already come out to say that they're very happy with what we're doing, very happy with the strategy, happy with the asset classes. And they've just invested 280 million euros into us at $1.51 because they can see the upside to our NAV of 2.05. So they recognize there's a 25% discount to NAV at a time when the NAV should be growing, at a time when valuations are growing with interest rate cuts. So with that, Gerald, I'll hand back to you. Thank you.
Thank you, Simon, for the sharing. So with that, we will come to the Q&A section of today's session. I'll invite all our speakers tonight to turn on their videos. And for the participants that have joined us tonight, you can ask your questions via the Pigeonhole link that is shown. I already see quite a number of questions that have come in. And what I will do is I will ask the questions that apply to all the 3 REITs first, before we go into the specific questions. Okay, I see this question that's come out, I think, questions on the percentage of your leases that are expiring or have potential risk of default in the near term. How are you actually managing it? Maybe I will start with IREIT.
Okay. So first, in terms of rent collection, we have no default at all because we collect 100% of our rents. So there is no weak tenant in our tenant base, I would say. How we manage the coming end of lease contracts is by anticipating a lot. So we are very proactive on our asset management side, and we talk to our tenants on a regular basis, and we talk about the coming end of lease contracts a long time ago, so that we are able to extend them, or at least have a very good view on their intentions, so that we can engage actions to replace them if they are to leave. So that's mainly the way we manage it, with a very careful and active asset management on every day.
Thank you, Peter. Josh, how is Elite UK REIT actually managing some of your potential expiries?
Yeah. So maybe on the arrears bit, I actually have 0 arrears. It's the UK government. They are the biggest and best pay master you can find. So I know, I think some have said that, you know, we have a lot of concentration risk in the government. But again, you know, if you're diversifying away from the UK government into, I guess, much lesser credits, then arguably that might not be the best diversification strategy. But I think for us, it is quite important that we have, you know, I think a very close relationship with our key tenant, the Department of Work and Pensions. They've told us that we are, you know, their largest landlord as well, or one of the largest landlord, and we do have a very close collaboration. One of the things that we did last year is that we renewed, we took away a lot of the lease breaks within our leases. There were a number of lease breaks in the past, and what we're looking at from that perspective is a 5-year of a chunk of government income between 2023 and 2028 with no risk to that. It is after all the UK government, you know, for them and ourselves. With regards to renewals, I think we're just getting that started very shortly. The UK elections has just completed this year, and also very recently the UK government has announced its budget. I think that is quite positive for us. And I think that gives our tenant a lot of comfort in moving forward with the lease renewal. So I think that's quite cool. The other way to look at it as well is, why would the tenant continue to stay in the majority of our portfolio? And there are a number of reasons for that. One, we are very affordable and probably very much under rented. On a portfolio basis, we probably at about 12 or 11 pounds per square foot per annum, which is really just £1, or I think from the Singapore context, $1.70 per square foot per annum per month, right? So that's very affordable. If the tenant leaves and seeks other real estate, given the climate of higher costs, build costs, the higher financing costs, I think the other landlords would have to charge a lot more in order for it to break even, to deliver the sort of same real estate. Again, the location is very core. These assets tend to be very well located in primary locations within cities and towns, usually on the main street or the street behind Main Street. So that's quite not something that's easily replicable in that. Last but not least, these assets are also very important in delivering the UK's social policy. As such, it's a bit hard for it to be unwounded within a short period of time. So I think that's really our take on this.
Thank you, Josh. And lastly, Simon.
Gerald, we've got 14% of our leases expiring next year. We've already released 65% of those well ahead of the expiries. We're running at about an 88% tenant retention of all of our office tenants. So again, back to the point that if you invest in the building, you'll be able to keep a large part of the tenants if they're in well-located parts of the gateway cities that we've invested in. So we're talking only about 3.6 to 3.8% vacancy in prime assets in Rotterdam, in Amsterdam, in The Hague, in Milan, in Rome. So very low vacancies. So that doesn't worry us in particular, that expiry risk, because again, not many options for those tenants. On the logistics side, because it's we've got more tailwinds and we're seeing much higher levels of rent growth, our tenant retention is actually lower at about 50%. So here is where we're looking for new economy tenants that are prepared and can pay higher rents than maybe an old economy tenant for that same space. So we're not as fussed about keeping a logistics tenant if we're able to get the higher rent. An example would be our centre in Denmark, which is the Nordics distribution centre of UPS. It's an older building, but they love the location. They're about to invest a substantial amount of robots, of automation for their sorting centre within this warehouse. And clearly they'd like to sign a very long lease if they're going to invest in robots within that shed. ABB in our Vittione Milan property, again, just happened to release. They make robots in that facility. So again, we're looking for assets where there's capital that's either been invested by the logistics tenant or about to be invested, because at that point, rent itself becomes secondary. It's more about how much capital they're investing in the property themselves, and therefore we're able to extract more value as the landlord for that prime location.
Thank you, Simon. Okay, the next question is around your distributions. I think that's what a lot of investors are naturally very interested in. So the question is, how do you intend to be able to sustain your dividend per unit? And are we considering any potential changes in terms of your distribution policies? Maybe we start with Josh this time around.
Sure. I knew that question was coming. Thanks, Gerald. So I think the two things, we think that because our rentals are all government rentals, so no one's going to the tenant will not be defaulting, and that's something that we know. The other bit as well is because I mentioned we have a high level of visibility of income. So on the top line, the revenue line, that's not going to be impacted, and that's with a fair bit of surety. Now, then, if you move further down the P&L from the net property income to DPU, the big swing factor here is really the cost of financing. That's usually takes up quite a fair bit of chunk out of it. Now, we have recently refinanced our debt. We have no refinancing till 2027. We have also instituted a very optimal structure in which we have a substantial revolving credit tranche within our loan facilities. What it means is that we get our 3 months rental in advance from the UK government, rather than let that go into a current account where we receive very little interest rates from the banks. We use that funding that we have to pay down our debt temporarily, and then to draw it back up in the months that we pay dividends in March and in September. So you see that our gearing will move up and down. September and then March will be slightly higher. June, December will be slightly lower. But through that, we optimize the costs of financing and return that back to our unit holders. So with the refinancing now locked and done away, and achieving a much lower cost of financing, that gives us quite a fair bit of stability. So I think DPU on itself, or distributable income on itself, should likely grow. Now then, the next question is on payout ratio. So I think the early part of last year in 2023, the management took the view that there were a number of risks in the horizon. The refinancing was not completed. We have a lease regearing exercise to execute. and I think gearing was trending lower. Gearing was trending higher, and we had to sort of retrench into a safer space, and then to go back up again when things are a bit restored. With now where we are at mid-year, we had a valuation. The valuation went up slightly at 0.6%, but I think more importantly, we're seeing a bit of an inflection point. Doesn't feel like the valuation is dropping, which is I think the first time since 2022. So I think we've got that checked. At the start of the year, we did a fundraising. Thanks to the support of our sponsors as well as all of the unit holders via preferential offering. With that, we had reduced our gearing. We had then, used that to extend our refinancing to do that. So we have actually locked away some of these core risks that we have. Now, I think the only thing left is really to increase the DPU payout ratio. And if I think the year-end valuation looks okay. I think that's something definitely I think we're keen to push up the DPU ratio or payout ratio much from its current 90%. I hope that answers the question.
Definitely. Thanks, Josh. Next, maybe we have Peter.
Yes. As far as IREIT Global is concerned, we are in a particular situation because we have this Berlin campus project, which will affect our rental income for next year and the year after. Anyway, on the rest of the portfolio, our main objective, as I mentioned before, is to increase the occupancy rate. And luckily, I would say we now see good momentum in the market, or at least better momentum in the market on the letting side, I would say, and this will hopefully help us to benefit from tailwinds on this side. Now, regarding Berlin project, when we think real estate, and this is a IREIT Global view, we think long term. So in our building in Berlin, we will suffer a drop in the rental income for the duration of the project. But this is something which will be more than compensated in the future rental income, which will be significantly higher than the current one, and especially I would say that it will be sustainable in the long term. So we are kind of doing a big project, asset management project to stabilize again our building for the next 10 to 20 years, and this is really the way we consider this. And maybe I can say a word that at this stage the project is working well, it's progressing well. We are about to announce soon some lease agreements that will be signed in the coming weeks, and this is on the hospitality side, and we see more and more interest as well on the office side. I would say that globally speaking, this is a really nice project that we are working on, and we will announce more and more information about that project, which will provide very good ESG credential, and I think will offer one of the best price quality positioning in Berlin market. So we are quite confident that this project will deliver and will deliver a high value. And on top of that, I would add that, okay, this is quite an unusual project for S-REIT, big unusual project for an S-REIT, but I would say that this is really business as usual for our two joint sponsors, TKO and City Development Limited, which on their own manage, I would say, several hundreds of millions euros of this kind of repositioning project every year. So we really benefit from their strong experience, expertise, local networks, and especially also financial support to properly steer this Berlin project and extract maximum value from the asset for the benefit of the unit holders. Anyway, with regard to the DPU, I would say, we will do our best efforts to mitigate the effects of the drop in rental income on the DPU, and that can be done by the sale of other assets or assets of the portfolio, or I mean, the company has the trust has cash on its balance sheet, so we have ways to manage this. This may not mitigate all the effect, but this can partly mitigate it. That's what I can say for IREIT Global.
Thank you, Peter. And lastly, Simon?
Yeah, so look, at the current share price, if an investor was to buy us tomorrow, they would, on forecasts of the 6 brokers that cover us, the forecasts of those brokers are averaging about 13 euro cents per unit. So the investor could expect to get around an 8.5% dividend yield. So when we talk about sustainability of dividend, we're already from a very high starting point of 8.5%. And this is in a very mature, large-scale, resilient portfolio. So why has our distributions fallen over the last couple of years? We were obviously at 16, 17 cents a couple of years ago. Why now down to 13? Well, it's because not just us, but almost every REIT globally has had to refinance their very cheap debt. You know, a few years ago, our debt was all in at 1.7%. So we've had to transition from low debt to a more moderate level, where our current cost is about 3.2%, and we've got one final piece to do, which may be a little bit higher than that. So we've already gone through the vast majority of the resetting of that very low interest rate. So one of the reasons our share price is up this year is because the market's implying, okay, you've managed that transition reasonably well, and in fact, that last piece of debt that you need to refinance could actually now be at a lower interest rate today than where it was 12 months ago. So there's a fair bit of that transition risk is now behind us. Look at the 6 brokers that cover us, have a look at their forecasts. They make those forecasts. We're not allowed to under the rules. We can't comment other than point you to those brokers. 13 cents gets you to about an 8.5% dividend. And we're trading at that 25% discount to NAV, when the likes of the very larger logistic REITs, both here and globally, are trading at or above their NAV. So as our strategy evolves, we deliver on the AEI, we deliver on the logistics pivot, then that should also contribute to the tailwinds.
Okay, thanks, Simon. I know we are past 7 p.m., but I see still quite a number of individual questions to the different REITs. And since it's quite rare to have all the REITs with European assets with us tonight, maybe I'll just ask each of you one question specific to your REIT. I'll start with Simon, since you started talking about your refinancing. I think this investor noticed that you recently announced a new 340 million debt facility. Can you walk us through the rationale of this facility with the current interest rate environment?
Yeah, thank you. So we have a bond that we issued in November 2020. And so that matures at the end of next year. And so we've put together an insurance policy or a bridge facility. That means we now can take our time to refinance that bond because we have this 3-year backstop. It's like an insurance premium. So as interest rates go down over the next 12 months, the board can take its time to sort of hit a spot that's lower than today without, the worries about, well, what do you do if the markets don't improve? So we've protected us from the downside risk of, well, you haven't done the bond yet, so when's that likely to happen? That question's been removed. It's now about taking advantage of the slower economic environment, the more interest rate priming or foot on the accelerator that the ECB will need to do over the next 12 months that enables us to benefit from that and issue new bonds. We've seen a substantial rally in the European bond market. and that's something that we can participate in because of our size. With that very large portfolio, we're able to access public debt, which gives us an advantage that we're not always reliant on the banks. So to be able to say to the banks, if you don't give us the money at the right rate, we're going to go to the public markets, and we can say to the public markets, if you don't give us the right rate, then we'll go to the banks. So we now have good tension between our bank lenders and our public bondholders.
Okay, thanks, Simon. Next is a question relating to IREIT. So question for Peter. Since you recently took over as CEO, is there something different that you want to be driving for the REIT?
Actually, I would say that I have really three priorities. I think part of them are really in the continuation that was done before by Louis, the former CEO, which by the way is now a director of IREIT. So he remains on the boat, I would say. I would say that priority number one is steer and deliver Berlin project. So this remains the main 2025 at least, and maybe the year after priority. Priority number two is to increase our occupancy rate, as I mentioned before, and the team is working really hard on this because occupancy is the engine of real estate. This is where everything comes from, I would say, in terms of value, DPU, etc. And to do that, we on a continuous basis improve our assets through regular capex injection, for example. And so we have a very proactive approach on all the asset management activities. And priority number three, and maybe this will be my difference, I have the objective to grow the size of IREIT because being big, in this market brings many benefits, such as the possibility to quickly diversify your asset portfolio, but also it will bring more liquidity to the shares, the IREIT shares. It helps lowering your financing costs thanks to better rating. And thanks to diversifying your funding resources, you can be including more resilient indices to improve your visibility, etc. So all of this is, to me, beneficial to the unit holders, and that may be what will be different with myself being at this position now.
Thank you, Peter. Okay, last question for Josh, something that is quite current, which is the recent UK autumn budget that was announced. What would be the potential impact to Elite UK REIT?
Thanks, Gerald. I think that's a very good question. I think it will affect us really in a few ways. Number one, I think on the taxes bit, or rather, it wouldn't really affect us as well. I mentioned, I think, in my presentation just now that we benefit from a UK REIT structure. So I think the recent budget that has been announced that there is an increase in the capital gains tax. We actually pay no capital gains tax. We don't even pay corporate income tax. The discretionary, the withholding interest rate that we pay is a concessionary rate of 15%. More all the other sort of landlords that does not have the UK REIT status will have to pay full withholding taxes. So the capital gains tax has been flagged as one of the taxes in the autumn budget, but it does not affect Elite UK REIT. So that's one. Two, I think something that we've been very closely watching is what happens to the budget with our key tenant here, the Department of Work and Pensions. Fortunately for us, I think there are some good news to share. The UK government has announced in their very inaugural Labour budget that they will be hiring 3,000 more staff in the fraud and error detection teams. Now, these fraud and error detection teams, if you were to hazard a guess, they tend to be within some of these job centers, and some of them will be those that we own. So that's quite a big hiring movement by the government for the DWP. So that's also in our favor. All in, I think the headline here is that the UK government is increasing the operational funding to the DWP by 6.3% to 10.8 billion pounds. So that's quite a generous, sort of contribution to the DWP. But partly it's also recognizing that there is a lot of error, a lot of fraud, and a lot of abuse in the financial assistance sort of programs that they had. So I think that's probably a step in a very good direction for not just our tenant, but also the UK general public and the public finances of the country. Third way, I think it will sort of affect us not immediately, but in the future. We've expressed that we have an aspiration to go into a residential in the future for rent. There are actually a number of housing schemes that are currently stuck in the planning system. So unlike in Singapore and where the URA will plan out master plans for the next 5-10 years, I think in the UK it's a ad hoc basis when if you want to change the land use to a different use, then you apply for planning, where I think the planners will have to assess a number of things such as fiber coverage, traffic, etc., before they sort of give that approval. So that is stuck because there is actually not enough manpower, not enough skilled people. So the government has pledged to hire 300 planners to unlock this system. So that's going to be very positive, not just for elite in the future, but in the general real estate climate in the UK right now. The last but not least, I think to fund all these projects that the government has, they have announced a sort of expansionary budget in a sense. It has to be funded some way, right? And I think they've told the market that in the longer term they will have to borrow to increase the borrowings to fund some of these projects. But I think the flip side of that is that we will then also see over time a higher growth in the later years. I think right now the forecast is that the UK economy will grow 1.5 to 1.8% in the next 3 to 5 years. So that's quite positive. And I think the flip side of that is there will be some pressure on inflation in the short to medium term. And I think that also will translate to a slower rate cut potentially. But from our perspective, we've taken the view, I think a few months ago, to hedge where we sort of did the refinancing. And we've done it at the rate that today, I think we're very much in the money. We've hedged, for example, the 3 years SONIA at about 3.8%, when currently I think the current market for 3 years term SONIA is 4.2%. So I think we've done well over there. And for the next 3 years, we are substantially locked away in terms of our interest rate exposure. Currently, we're about 87% hedge. The remaining that we do not hedge is really the revolving credit loan that I talked about just now. So that goes up and down. That's a bit harder for us to forecast.
Okay, thank you, Josh. Maybe just as a final question, it's a question for all the management that we have with us tonight. Maybe just to round up the discussion today, what are some of the key priorities that you are going to be working on over the next few years, and why should investors be looking at your REIT? Okay, maybe we can start with Peter.
Well, the priorities I've mentioned them before. But I think I think it's important to first to diversify your. From an investor point of view, globally speaking, it's always a good idea to diversify your investment portfolio. And with regard to real estate, as it was mentioned before as well, real estate is a cyclical business. It is pretty linked to interest rates, for instance, and global economy, and all these interest rates and global economy are cyclical as well. So if you want to protect your portfolio, investment portfolio, it's a good idea to diversify, and having lines on Europe European real estate is, to me, quite a good idea, just to hedge for hedging. And then I would say that okay, we have different, or the three of us have different strategies, but I think what is important is to be exposed to the European market, then it's I would say a question of convictions on asset classes, on how we can improve our asset portfolio, and we're here, of course, to promote that. But globally speaking, I would say that again, diversifying is key to me, and having lines in Europe is quite important in any case, I would say.
Thank you, Peter. Next, maybe Josh.
Yeah, I think if you recall my slide, I think really three things that we want to focus on. One, very quickly, proactive asset management. That's about renewing our leases. That's about conversion of our assets, some assets, to make sure that we get the best value of our real estate, to get the highest and best alternative uses where possible. Number two is capital management. We still want to, get our gearing to a sub 40% level over time, and some of our actions in the asset management side of things will actually, contribute to this. Last but not least, improve liquidity. I'm actually calling into this call right now from Hong Kong, where we're meeting investors. So it's very important for us to, widen our analyst, our media coverage, our, investor relations. And at the end of the day, I think we do need to grow eventually, so that we have more liquidity and also to be included in an index going forward. I think these are the three things that we definitely are very, very focused on. Thank you.
Thank you. Lastly, Simon.
We're very focused on driving unit holder returns. We want to see a higher share price, and we want to see that sustainability of dividend and that discount to NAV get closed. How do we do that? We continue the pivot to logistics. We know that that provides the solution to those two issues, driving share price, because that's where the high return on equity is derived from, ultimately driving higher dividends and closing that gap to NAV. And then in our office portfolio is taking advantage of some of our very well located office assets and converting them to prime assets and taking advantage of that development profit, leaving that within the REIT so that our NAV grows and not the sponsor or not another developer. We do that within the REIT. And we've just developed our first project in Nevesa, proof of format, and we're going to keep rolling that out. So driving unit holder price, sustainable dividend, active management of our assets, pivoting to logistics.
Thank you, Simon. And with that, we'll end today's sharing on the European REITs. Thank you for the management teams from IREIT Global, IREIT UK REIT, as well as Cromwell European REIT to give us an overview of your REITs tonight and answering the questions that different participants have. I'd also like to thank Tom for your sharing on the outlook for the European real estate sector. For participants who have joined us tonight, thanks so much for your time in joining us. If you've got further questions, do feel free to reach out to the investor relations of the different REITs, where they'll be able to answer more of your questions. If you'd like more insights on the Singapore REITs, do visit our website, growbeansprout.com, where we'll continue to provide you with updates on the European REIT sector. So thanks so much, everyone, for joining us tonight. I hope you found today's session helpful, and I look forward to seeing you at the next SGX Discovery series. Thank you.